I'm back, baby.
Welcome back to the Canadian Portfolio Manager podcast, where we help you better understand and manage your ETF portfolio. I'm your host, Justin Bender, and today we'll be introducing you to our lite model portfolios, also known as the Price's Lite models. We'll also talk about the pros and cons of asset allocation ETFs in general. And finally, we'll help you decide which ETF provider is right for you, Vanguard or iShares. You may have already noticed on the blog, but there are now 4 CPM model levels of complexity to choose from: Lite, Ridiculous, Ludicrous, or Plaid. As you might guess, each of our model's 4 levels is more difficult to manage than the last, and arguably more powerful. It might be less obvious where the levels' names come from. Everyone has heard of the speed of light. The others were inspired by one of my favorite movies, Spaceballs, where there's also the speeds of Ridiculous, Ludicrous, and Plaid.
Prepare ship for light speed.
No, light speed is too slow.
Light speed too slow?
Yes, we're gonna have to go right to ludicrous speed.
In this series of podcasts, I'll discuss each of our 4 model ETF portfolio levels in painstaking detail. Even if you're tempted to exceed the speed of light, you'll want as much knowledge as possible to make an informed decision before hurtling headfirst into a complicated portfolio you may regret. And by the way, I've decided to exclude the BMO asset allocation ETFs in these discussions, mainly because they don't offer US-based versions of their products. This will be more important when reviewing the other 3 more complicated models. So if you decide to go with our light portfolios, you could also consider the BMO asset allocation ETFs. So raise your hand if this sounds like you. You have very little investment experience, a smallish portfolio, and or too many other things you'd rather be doing in your free time. If any combination of these traits apply to you, our lite model ETF portfolios might be just the ticket for you and your investment adventures. Using single fund Vanguard or iShares asset allocation ETFs, you'll get diversified exposure to global equity and fixed income markets at a fraction of the fees charged by most Canadian-based mutual funds. The Lite portfolios are available for download in the Model ETF Portfolios section of the CPM blog. Clicking on either the Vanguard or iShares Asset Allocation ETF buttons in Step 2 will generate the report in a separate tab. At this point, you may want to hit pause on the podcast and download one of the Lite Model ETF portfolio reports just so you can follow along with me. The Vanguard or iShares portfolios are displayed from left to right, ranging from a very conservative 80% bond, 20% stock portfolio, all the way to a very aggressive 100% stock portfolio. And for either fund company, their 5 asset allocation ETF names and tickers are listed below the blue and gray donuts. So what if you're not satisfied with the single fund model portfolios? It might detract from the simplicity of a one-fund solution, but you could split your cash between 2 of the 5 one-fund solutions. For example, you could invest half your money in the Vanguard Balanced ETF portfolio, VBAL, and the other half in the Vanguard Conservative ETF portfolio, VCNS. You'd then have a custom 50-50 stock-bond mix. But be forewarned, you will now be the one responsible for keeping roughly equal amounts invested in each fund. Below the ETF tickers, you'll find the percentage weights allocated to each of the underlying ETFs. The individual ETF names can also be found on the far left of the report. Near the center of the report, you'll find the estimated management expense ratio, or MER, for each of the asset allocation ETFs. This is the annual percentage cost to invest in the fund. And new this year, we've added my foreign withholding tax ratio, or FWTR, which estimates the unrecoverable foreign withholding taxes in tax-deferred accounts like RSPs and RIFs, tax-free accounts, and taxable accounts. Further down, the report displays hypothetical past returns of each model portfolio. Just remember, this doesn't tell you much about future returns. And new for 2020, we now have 25 years of semi-fictional performance. If you'd like to read up on the performance methodology, you can check out more details on page 2 of the report. Although honestly, I've never been asked a single question about it. More importantly, in bright red near the bottom of the report, you'll find each fund's worst one-year return over the 25-year period. Pay close attention to these figures. Ask yourself, are you really comfortable with these types of losses? because you will eventually experience similar or likely worse short-term returns in your actual portfolio. Now that you're familiar with the lite model portfolio reports, let's discuss some of the advantages and disadvantages of using all-in-one asset allocation ETFs. First, here are the 5 benefits. Number 1, it's less effort. It doesn't get much easier than this. As I mentioned earlier, you only need to place a single trade to gain access to thousands of Canadian and foreign stocks and bonds. Also, you won't need to rebalance your portfolio to maintain its asset mix. iShares or Vanguard will take care of that for you. Number 2, there are potential cost savings. Asset allocation funds can save you money on trading commissions when you add new money to your accounts, as you only have to buy a single ETF to invest your cash. Many of the big bank discount brokerages still charge investors around $10 per trade. Also, management expenses are extremely low, at around 0.2% for the iShares portfolios and 0.25% for the Vanguard portfolios. Number 3, there's less to worry about. Since you can't readily see the underlying funds in a single fund structure and how each fund is doing relative to the others, you should be less tempted to tinker with the portfolio, which is usually to the detriment of your end returns. Number 4, you can simplify your tax management. Tracking your adjusted cost base in taxable accounts will take less time. You'll only need to track the adjusted cost base of a single ETF instead of for numerous funds. And number 5, it makes for easier portfolio management. A couple of the asset allocation ETFs allow you to arrange pre-authorized cash contributions, or PACs, for automatically purchasing more fund shares each month. PACs offer the ultimate set-it-and-forget-it investing experience. Now, to the inevitable trade-offs for all this convenience. There are 4 I'll mention here. Number 1, what you see is what you get. Since you can adjust the underlying holding weights to suit your preferences, if you want a lower allocation to Canadian stocks or a higher allocation to emerging market stocks, you're out of luck. Number 2, there's less flexibility. Although the iShares and Vanguard asset allocation ETFs come in 5 flavors of risk, you may still prefer a different asset mix for your own portfolio. In this case, you'll need to combine at least 2 ETFs together, as I described earlier. This can totally defeat the product's simplicity. Number 3, brace for higher costs. The MERs are slightly higher than if you had just purchased the underlying ETFs directly. Foreign withholding taxes may also be higher. And number 4, expect some tax inefficiencies. When held in a taxable or non-registered account, the underlying bond ETFs can be slightly less tax efficient than other fixed income options. This is due to the tax inefficient premium bond holdings, which I'll explain in a future episode. Also, since you hold the same ETF in every account, you can't engage in tax-wise asset location strategies, and tax loss selling opportunities may not pop up as often. If you made it this far, you're probably realizing, while asset allocation ETFs are imperfect, they're still a pretty good option for most do-it-yourself investors.
Pretty good. It's pretty good.
In the second part of the show, we'll check out the main differences between the iShares and Vanguard asset allocation ETFs. We'll also review how, or if, these differences have impacted historical risk and returns over the past 2 decades. And here's a spoiler, they mostly have not. But before we do, let's lighten up this discussion with another
ETF Combat,
where we pit 2 ETFs against one another to test their might. In today's showdown, the Vanguard Canadian Aggregate Bond Index ETF, with ticker symbol VAB, will face off against a new rival, the Vanguard Global Aggregate Bond Index ETF Canadian Dollar Hedged, with ticker symbol VGAB. Although both ETFs provide diversified bond exposure to help you weather those severe market downturns, there can be only one winner in this.
ETF Combat. Round 1. Fight!
In 2012, VAB sported an MER of 0.26%, and over the years, Vanguard continued to lower VAB's MER to where it stands now, at just 0.09%. In 2020, Vanguard launched VGAB, with an expected MER of around 0.34%. This might have been a reasonable fee back in the day, but it's unlikely to impress anyone these days.
Hey, VGAB, 2012 called. It wants its MER back. Boom. I still got it.
The fee seems especially high, given that VGAB simply holds two existing ETFs, VBU and VBG, which in turn hold US-based ETFs, BND and BNDX. The weighted average product fees of BND and BNDX would be around 0.07% if you bought them directly on the US stock exchange. Sure, you wouldn't have currency hedging, and you need to transact in US dollars, and you need to occasionally rebalance between your two ETFs. But investors shouldn't have to pay a 0.27% premium for these benefits. It shouldn't be like an overpriced bottle of wine at a fancy restaurant. It's just a boring bond ETF. I also find the initial price point of VGAB interesting, as Vanguard Canada have already released more useful asset allocation ETFs which include the same currency hedged global bonds, plus Canadian bonds, plus Canadian stocks, plus foreign stocks, all for a lower price of just 0.25%. With bond yields hovering around 2% these days, I think I'd pass on this asset class until fees come down.
VAB wins. Round 2. Fight!
Relative to a Canadian-only bond allocation, adding a dose of currency-hedged global bonds to your portfolio is expected to reduce its volatility, especially for more conservative asset mixes. Vanguard obviously knows this, which is why they've chosen to include global bonds in their popular asset allocation ETFs. Over the past 20 years, ending December 31st, 2019, a portfolio that included global currency hedge bonds did have a slightly lower risk across the board, from a conservative 20% stock, 80% bond asset mix, all the way to an aggressive 80% stock, 20% bond allocation. As I'm all for reducing portfolio risk without giving up so much in return, we'll award this round to the bond ETF that smooths the investment ride.
VGAB wins. Round 3. Fight!
If you thought the management fees on VGAB were high, you're going to hate its foreign withholding tax ratio. The foreign withholding tax ratio, or FWTR, measures how much income you can expect to lose in percentage terms each year on your ETF distributions. It's expected to be around 0.23% if you hold VGAB in an RSP or TFSA. These taxes are lost forever, so think of it like an additional MER. If we combine this with the expected MER of 0.34%, we end up with a total cost of 0.57% per year. And if we assume global currency hedge bonds are expected to return around 2% going forward, you'll be giving up nearly 30% of your return to fees and taxes. In comparison, VAB is expected to lose less than 5% of its return to fees each year.
Finish it!
Simply put, VAB will lose far less to fees and taxes than VGAB. VGAB may have a leg up when it comes to diversification, but this benefit is hard to justify when its return will be significantly eroded over time. However, once Vanguard provides additional fee and fund structure improvements, VGAB may become a decent option for portfolios in the future.
Bond Voyage. VGAB. VAB wins. Frugality.
Now, as mentioned before the match, we're now going to pop the hoods on the iShares and Vanguard lite portfolios to help you make a decision on which option is right for you. The first difference between the two is their split between Canadian and foreign stocks. Investors and ETF providers alike tend to overweight their home country's stocks. In fact, the tendency is so common it has a name: home bias. The Vanguard and iShares portfolios are no exception to this rule. They're also overweighted in Canadian stocks relative to foreign stocks. Canadian stocks only make up around 3% of the global stock market, but Vanguard and iShares have both provided a higher weight to domestic stocks in their portfolios. In all 5 of their funds, Vanguard has allocated 30% of their equity mix to Canadian stocks and 70% to foreign stocks. iShares, on the other hand, has split their equity allocation 25-75 between Canadian and foreign stocks. You may be tempted to favor the iShares ETFs. and their higher allocation to foreign stocks. After all, over the past decade, foreign stocks have outperformed Canadian stocks by around 4.6 percentage points per year. Before you decide, though, check out how dramatically fortunes were reversed in the decade just prior. From 2000 to 2009, Canadian stocks crushed foreign stocks by an average of 8.2 percentage points per year. And besides, remember that past performance tells us little about what to expect next. If you had been invested over the past 2 decades, it would have made little difference whether you had selected a 30-70 or 25-75 Canadian foreign stock split. Vanguard's 30-70 weights would have slightly outperformed the iShares 25-75 allocation, but only by an average of 0.1% per year. And both portfolios would have had similar risk with similar standard deviations at around 11.5%. So if you're still torn on which company to invest with, know that a 5% difference in Canadian stocks isn't likely to have a noticeable long-term impact on risk or returns. And by the way, for a handy summary of these somewhat complex comparisons, you may want to check out our blog on today's subject. Beyond this essentially insignificant equity home bias difference, there's a noticeable difference in how each company manages the foreign equity allocation within the portfolio. Vanguard weights their U.S., international, and emerging markets equity allocations based on their current market cap. This lets these asset classes fluctuate freely within the constraints of the overall 70% foreign equity allocation, based on the relative stock market values in each region. iShares has instead chosen specific target weights for the U.S., international, and emerging markets allocations. They stick to these target weights no matter what daily stock markets do. Think of Vanguard's strategy as being like the diet someone might take if they weren't obsessed with their body weight. They might put on an extra 5 pounds during the winter, figuring they'll lose the flab during beach season. The iShares strategy would appeal more to a disciplined health fanatic who weighs themselves daily and diets accordingly, lest they shed or gain an unwanted pound. Given their current target weights, the iShares foreign equity allocation underweights emerging markets and overweights developed markets by around 5.8% relative to Vanguard. So if you prefer more emerging market stocks in your portfolio, the Vanguard asset allocation ETFs may be the way to go. If we adjust the foreign equity weights in our iShares 25% Canadian, 75% foreign stock index portfolio, we actually find this change resulted in slightly higher performance than our Vanguard 30% Canadian, 70% foreign stock index portfolio, 5.1% versus 4.9%. But they both still had similar risk. Next up, let's check out the fixed income differences between our Vanguard versus iShares lite portfolios. Within the portfolio's fixed income allocations, Vanguard targets 60% Canadian and 40% foreign bonds. They also hedge away the foreign bonds' currency risk, which makes them behave more like Canadian bonds. U.S., international, and emerging market bonds are all included in this foreign bond allocation. Similar to their equity allocation, the split between these foreign bond regions are determined by their current market caps, not by a specific target weight. Again, other than the 60-40 split between Canadian and foreign bonds, there's very little active decision-making going on here. This is ideal for those investors who prefer a more hands-off approach to indexing. In comparison, iShares targets 80% Canadian and 20% foreign bonds in their portfolios. And like Vanguard, they also hedge the currency risk of their foreign bonds. But unlike Vanguard, their foreign bond allocation is entirely U.S. bonds, split evenly between government and corporate investment grade bonds. The iShares portfolios have also swapped out a portion of the broad market Canadian bonds for shorter term corporate bonds, which has reduced the average duration of the bond portfolio. And duration is a measure of a bond's price sensitivity to interest rate changes. So the iShares portfolios may be right up your alley if you prefer more corporate bonds in your portfolio with less duration risk. As most Canadians allocate a portion of their portfolio to bonds, I've run the historical performance over the past 2 decades on a typical balanced 60-40 stock bond index portfolio, which incorporates most of the equity and fixed income differences just discussed. Again, you can reference the details in the blog version of this podcast. But to cut to the chase, we find identical performance and risk for both portfolios. In other words, even with all the slight differences between how Vanguard and iShares construct their asset allocation ETFs, we wouldn't expect there to be much long-term difference in risk and returns. So bottom line, you should feel comfortable no matter which option you choose. If there's one rather obvious difference between iShares and Vanguard, it's their annual fees. The iShares portfolios are slightly less expensive than Vanguard's at around 0.2% versus 0.25% respectively. However, a 5 basis point difference is hardly a sufficient reason to prefer one company's funds over the other, especially in a smaller portfolio. For example, the fee advantage is only worth about $5 per year on a $10,000 investment. In terms of portfolio rebalancing, both Vanguard and iShares will take care of this for you. iShares plans to occasionally rebalance their portfolios at their discretion. They don't expect to allow any asset class to deviate by more or less than 10% of its target weight. For example, the iShares Core Balanced ETF portfolio, XBAL, has a Canadian equities target weight of 15%, invested in the iShares Core S&P TSX Capped Composite Index ETF, XIC. So if XIC became more than 16.5% of the portfolio, which is 15% plus 15% times 10%, iShares would likely sell a portion to bring the asset class back in line with its target. Likewise, if XIC became less than 13.5% of the portfolio, which is 15% minus 15% times 10%, iShares would likely sell a portion of any overweight ETFs and use the proceeds to buy more shares of XIC. In reality, iShares will typically use investors' new cash flows to top up any underweight asset classes. This should reduce the need to rebalance by selling securities at a gain. Vanguard also plans to periodically rebalance their portfolios at their discretion. They don't expect to allow any specific fund to deviate by more or less than an absolute 2% of its target weight. For example, VBAL has a Canadian equities target weight of 18%, invested in the Vanguard FTSE Canada All Cap Index ETF, VCN. If VCN were to become more than 20% of the portfolio, which is 18% plus 2%, or less than 16%, which is 18% minus 2%, Vanguard would likely spring into rebalancing action. Once again, they would try to use investors' new cash flows to top up any underweight asset classes, reducing the need to sell existing securities. Two of the iShares asset allocation ETFs, XBAL and the iShares Core Growth ETF portfolio, XGROW, are still eligible for pre-authorized cash contributions, or PACs, at select brokerages. The PAC program allows investors to automate their portfolio contributions and their share purchases for either XBAL or XGROW, effectively putting their portfolio management on autopilot. This is because, instead of launching new ETFs back in December 2018, iShares simply changed the names, tickers, fees, and investment objectives of two existing balanced ETFs. These ETFs were themselves relics from the old Claymore days, when the PAC program originated. Thanks to this grandfathering provision, investors in these two specific ETFs can still participate in the PAC program, at least for now. If that's of interest to you, here's how it works. First, fill out the iShares PAC enrollment form, attach a void check, and mail the documents to a participating discount brokerage you invest with, like Questrade. Questrade will then complete their portion of the form and provide it to State Street Trust Company Canada, SSTCC, for processing. Once setup is complete, which is after around 10 days, SSTCC will start to debit your bank account near the end of each month for the amount you specified on the form, which must be at least $50 per month. The actual purchase occurs at the beginning of the following month, and the shares arrive in your brokerage account around mid-month. Only whole shares can be purchased, so any leftover cash is refunded to your bank account around the 5th of each month. So if you're targeting a specific monthly savings amount, you may have to occasionally move the leftover cash from your bank account back to your brokerage account and invest it yourself. So why even bother with all this? Well, maybe you don't trust yourself to buy more shares of your ETF through thick and thin, or maybe you'd rather spend your spare time doing something more exhilarating than placing ETF trades, like watching or rewatching Spaceballs the movie. If so, the convenient PAC program may be just the thrust you'd need to accelerate your XBAL or XGROW investments. Now before we go, let's check to see if we have any new voicemail messages from our listeners.
You have one saved wireless voice message. First saved message.
Hi, Justin. This is Emily from Vancouver. Thank you for all that you do for DIY investors such as myself. My question pertains to your recommendation for investors who hold VGRO in their taxable account during retirement. Many of us would be uncomfortable selling during stock market downturns. I'd be interested in your approach with allocations to bonds, ladder GICs, and or cash alongside these asset allocation ETFs as one approaches retirement. Thank you.
Thank you for this very thoughtful question, Emily. Buying an asset allocation ETF during your pre-retirement years is relatively straightforward. Whenever you add new money to your accounts, you simply purchase more shares of the ETF. And over time, your ETF will hopefully grow in value. For taxable investors, though, this can reduce their portfolio's flexibility, as they now have a single ETF position with, again, hopefully a large unrealized capital gain. Now, the average investor does not want to retire with an 80% equity, 20% fixed income asset mix. An easy solution would be to sell their VGRO position 5 or so years before retirement and replace it with a less aggressive asset allocation ETF, like VBAL or VCNS. However, they would not only realize the entire capital gain in a single tax year, it would likely be during their highest income earning years. So there's a number of more tax-efficient ways you can prepare your portfolio for retirement while still hanging on to your aggressive asset allocation ETF. First, you could build a ladder of GICs with new savings before you retire. For example, let's say you currently have $1 million invested in VGRO, with an embedded $500,000 unrealized capital gain. We'll also assume you pay taxes at the top tax rate until retirement. You're planning to retire in 6 years, at which point you'd like to retire with a portfolio that is split evenly between stocks and bonds, including cash. You also plan to save $100,000 each year in your taxable account for the next 6 years, and you plan to spend $50,000 annually in early retirement. So once you've saved your first $100,000 of cash in year 1, instead of purchasing more units of VGRO, you could purchase a $100,000 GIC maturing in 5 years. Just a note, I've used $100,000 to keep the numbers simple, but always mind the CDIC limits. In year 2, you'd buy another $100,000 5-year GIC, and so on. Over time, you would have created a 1 to 5 year GIC ladder with $100,000 invested in each rung. In your 6th and final year, you could simply invest your $100,000 of cash savings in an investment savings account, ready to spend in your first 2 years of retirement. If we ignore any investment growth, your total portfolio would be worth around $1.6 million at retirement. As you were targeting 50% in stocks at retirement, or $800,000 in stocks, the 80% allocation to stocks in your $1 million VGRO position would fit the bill. Your remaining fixed income and cash holdings would include the 20% allocation to bonds in your $1 million VGRO position, your 1 to 5 year GIC ladder worth $500,000, and the $100,000 of liquid cash available in your investment savings account. If your additional savings before retirement won't reduce your portfolio risk in time, you could begin reinvesting some or all of the quarterly distributions from VGRO in a tax-efficient bond ETF, like the BMO Discount Bond Index ETF ZDB. In our $1 million VGRO example, the fund is expected to distribute over $25,000 each year, which could be used to purchase more units of ZDB. This would help reduce your overall portfolio risk as you approach retirement. And as your ZDB holdings grow in value, you could also consider occasionally selling some of the units and building a GIC ladder, which can eventually be used to fund your early retirement expenses. So once you retire, you can then begin to strategically and tax efficiently sell a portion of your VGRO units. Hopefully by this time you'll also be in a lower tax bracket. And in years when stock markets are up, you can sell a portion of your VGRO holdings to top up your bond, GIC, or cash holdings. And in years when markets are down, you can just live off your cash and fixed income holdings until stocks recover. By now, I hope you've realized An asset allocation ETF from either Vanguard or iShares would be a great choice for most investors. If you prefer one based on our discussion, great. If not, flip a coin. Heads or tails, you win. This is especially true if you compare either strategy to the hyperactive floundering most do-it-yourself investors engage in as they make their way across the ETF universe. That said, for those of you who think light speed is too slow, we can crank up the complexity level and squeeze even more power out of your investment engines. In the next episode, we'll introduce you to our ridiculous model portfolios. Until then, may the investment force be with you.